The gold mining sector has been absolutely crushing it lately, and there's a lot to unpack here. Let me break down exactly what's happening and why it matters for your investment strategy. First off, gold miners have been seeing incredible revenue increases thanks to higher gold prices. But here's what's really interesting, it's not just about the top line. The best run miners are converting these higher revenues into substantial earnings and robust cash flow. But let me give you some concrete examples. Companies like Newmont and Barrick Gold have reported margin expansions of 15 to 20%. Operating cash flows for top miners are up significantly year over year. Many companies are exceeding their production guidance while maintaining cost discipline. What's particularly impressive is how these companies are managing to improve their operational efficiency while benefiting from higher gold prices. It's like getting a double boost: better prices and better operations. Now, here's something really fascinating that not enough people are talking about. Gold and silver miners have been significantly outperforming physical gold ETFs like GLD. Let me break down why this matters. Think about it this way: when gold prices rise by 10%, a physical gold ETF also rises by roughly 10%. But miners, their profits can increase by 20%, 30%, 30%, or even more. Why? Because their costs stay relatively stable while their revenue increases substantially. This is what we call operational leverage, and it's a game changer for investors. For example, if a miner's cost to produce an ounce of gold is $1,000, and gold prices rise from $1,800 to $2,000, their profit per ounce jumps from $800 to $1,000. That's a 25% increase in profit from just an 11% increase in gold price. Speaking of profits, let's talk about what's coming up. With gold prices reaching new highs in the third quarter, we're expecting to see some pretty impressive earnings reports. Here's what analysts are predicting. 1. Record revenue growth. Many companies expected to report 20% year-over-year growth. Higher realized gold prices driving top-line expansion. Increased production volumes, adding to revenue gains. 2. Improved margins. Better operational efficiency. Cost containment measures taking effect. Higher gold prices, expanding profit margins. 3. Stronger cash flow generation. Enhanced free cash flow yields. Improved return on invested capital. Better capital allocation opportunities. This upcoming earnings season could be a major catalyst for the sector, attracting momentum investors who love to see consecutive quarters of earnings growth. Now, it wouldn't be a complete analysis if we didn't talk about the challenges these companies face. Despite the positive momentum, miners are dealing with some significant headwinds. 1. Rising operating costs. Energy expenses have been climbing steadily. Labor costs are increasing due to wage inflation. Equipment and maintenance costs remain elevated. Supply chain issues still affecting operations. Some countries considering mine nationalization. Changing royalty structures. Political instability in key mining regions. Regulatory uncertainties. These challenges aren't insurmountable, but they're forcing companies to be more strategic in their operations and more selective about where they invest. Let's zoom out for a minute and look at the bigger picture. One of the most significant risks right now isn't actually in the mining sector, it's in other parts of the market, particularly in tech stocks and the NASDAQ. Here's why this matters for gold mining investors. Many tech stocks are trading at historically high valuations. A geopolitical crisis could trigger a significant market correction. Overvalued sectors could face substantial selling pressure. This could lead to a flight to safety, benefiting gold miners. History shows us that during market stress, 1. Investors typically shift capital to safe haven assets. 2. Gold and silver prices tend to rise. 3. Mining companies often see increased investor interest. 4. The sector can benefit from both higher prices and increased demand. This brings us to an important point about gold's role as a safe haven asset. During times of market stress, precious metals typically perform well, and here's why this matters for miners. 1. Traditional safe haven benefits. Portfolio diversification. Inflation hedge. Currency devaluation protection. Geopolitical risk hedge. 2. Operational advantages. Higher metal prices improve margins. Increased investor interest can drive stock prices. Better financing opportunities. Enhanced M&A potential. Speaking of M&A, we're seeing some interesting developments in this space. Strong cash flows are enabling larger mining companies to look at strategic acquisitions, particularly among junior exploration firms. Why this matters. 1. For major miners, opportunity to replenish reserves. Access to new mining districts. Operational synergies. Growth potential. 2. For junior miners. Premium valuations in takeovers. Access to capital. Technical expertise. Faster project development. We expect this trend to accelerate as gold and silver prices remain elevated, creating opportunities for investors who can identify potential takeover targets. One of the most encouraging developments in the sector is how companies are managing their cash flows. Unlike previous cycles where miners might have overspent on ambitious projects, we're seeing much more disciplined capital allocation. 1. Shareholder returns, increasing dividend payments, share buyback programs, special dividends in some cases, improved payout ratios. 2. Strategic investments, targeted expansion projects, technology and automation, sustainability initiatives, exploration programs. 3. Balance sheet management, debt reduction, working capital optimization, maintenance of cash reserves, credit facility management. So what does all this mean for investors? Here's how to approach the sector.
1. Company selection criteria.
Focus on operators with low-cost mines. Look for strong balance sheets. Consider jurisdictional risks. Evaluate management track records. 2. Portfolio considerations. Determine appropriate allocation size. Balance between majors and juniors. Consider streaming companies as alternatives. Monitor correlation with other holdings. 3. Risk management. Diversify across multiple companies. Monitor geopolitical developments. Keep track of cost inflation. Watch technical indicators. The gold mining sector is at a fascinating juncture. While challenges exist, the combination of higher gold prices, improved operational efficiency, and disciplined capital allocation makes this sector particularly attractive. Key takeaways. 1. Strong fundamentals supporting the sector. 2. Multiple potential catalysts ahead. 3. Improving capital allocation discipline. 4. Attractive valuations relative to broader market. Before we wrap up, remember that investing in mining stocks requires careful due diligence and risk management. Focus on companies with strong management teams, quality assets, solid balance sheets, sustainable business practices. That's it for today's deep dive into the gold mining sector. If you found this analysis helpful, don't forget to like and subscribe for more market insights. Drop your thoughts and questions in the comments below. Thanks for watching, and I'll see you in the next video.